Now, before we get started, let me introduce to our speaker today. His name is Alex Siu. Alex is actually the first chairman of a Malaysia chapter of a CMT Association. He has extensive experience in the fund management, and formerly he served as a fund manager in VCB Capital, a boutique asset management company, for more than 5 years. And currently, Alex is the fund director of SC licensed robo-advisory firm, which the company's name is the BH Global FinTech Solutions Sendirian Berhad. And Alex is specializes in trading systems and strategies, value investing, trading psychology, as well as designing and developing and programming machine learning algorithm for a robo-advisory. So without further ado, let me pass this presentation to Alex. Alex, back to you.
Okay, thank you. So, yeah, hi everyone. Yeah, I hope all of you are keeping well during this pandemic time. Yeah, most important, stay safe and stay positive. And today's session, I hope that it can give you all some new ideas how to trade your favorite products, FKLI and FCPO. Okay, let me just share my slides first, then I'll continue. Okay. I hope all of you are able to see the slide. Okay, anyone of you not able to see the slide, please let me know.
Okay, yes, your slide is up, Alex.
Okay, no problem. Yeah. Okay. Right. I'll just give some disclaimer. So this is my own. These are all my own knowledge and personal experience. I'm not going to sell anything. I'm not going to sell any software or give any advice. So, and it's also meant for knowledge sharing purpose only. Okay. Right. So certain parts like performance, all these are intentionally excluded so that we are not going to show you certain details. Okay. As well as some of the details are our own company's intellectual property, so I will not be sharing totally everything. I'll just tell you, some of you might not have actually seen me before. Okay, it might be your first time. How many of it is not your first time? Okay, audio loss, is it? Sorry, is there an audio loss? Are you able to hear me, sir?
Yes, I'm able to hear you.
Hear, right? Oh, some of the audience say it's audio loss. I hope it's fine. Okay, audio okay, yeah, everyone is okay. Okay, how many of you have never seen me before? It's your first time. Can you just put a 1? If you have seen me before, can you put a 2 on the chat box, please? Thank you, so that I know whether am I talking to the same audience. Okay. Well, most of you put a 1, means you have actually, actually most of you have never seen me before, have never, yeah, okay. Okay, sometimes I get a bit too technical. Inaudible, again, is some audience say inaudible. Okay, you help me to check. As long as you can hear me, I think fine.
Okay, yeah, sure.
Right. Yeah. Okay. So some of you too. All right. Okay, but majority is 1.5. So I'll go a bit slow because sometimes people say I talk too fast, and also, okay, and too technical. If it's too technical, that's fine. Okay. Basically, today's topic is meant for you to have some new ideas. Okay, it's not meant to teach you a strategy that can make a lot of money. Of course, yeah, there are certain details that are omitted, and of course, our robot just launched, which is the IRO. Okay, and there are many other robots that are in the market. So if you're interested, you can go and find out. Okay, so I'm not going to do any marketing. Let me carry on. Okay. Today's content is about volatility modeling. Okay. And specifically for FCPO and FKLI. Okay, so okay, newbie is fine. So some of you say they are newbie, so I'll make this a bit more easier and clearer. Okay, so that you will not be lost. Okay, because if all of you say type in the chat box, I'm an expert. Okay, then of course I will actually go more in depth. Okay, so quite a few of you say I'm a newbie. So I'll just go more surface and basic first. Okay, so most important, you have to understand the word volatility. Okay, volatility always changes. Okay, the only thing that doesn't change is volatility always changes in the market. The market's volatility never stays the same. Yeah, and the reason why there was one very famous fund, which is called long-term capital fund. They lost a lot of money. That fund was by a few, I think most of you know, by a few Nobel Prize winner, the creators of Black-Scholes model, is because they assume that their formula assumed that volatility will stay the same. so that they pay a big price for their mistake, this wrong assumption. So always assume that volatility will change. Okay, so why do I want to talk about the turtles? Okay, right, the turtles, because the turtles is, first of all, it's a very fun story. Okay, and second thing is it is the story of volatility, and it's the first time actually people heard of using volatility or modeling volatility in trading. That was actually the first time in 1984. Okay, right. So how many of you have heard of the turtle story? Can you just type a yes? You have not heard of the turtle story. Can you type a no, please, so that I know how fun do I want to be? Okay, yeah, if or how more in depth I can go. You can really go very deep into the turtle story. So those of you who say yes, okay, it's a mix of half. I think more of no. Okay, right, fine. Okay, so I'll just tell you about the turtle story and what we can learn from early days volatility modeling. Okay, all right, let's carry on the story. Okay, Richard Dennis and Bill Eckert, they were very famous traders, okay, in their time, which is around 1950s, 1960s, 1970s, and they have become very successful and very famous in 1980, okay, around 1980. So what they did is that they went to Singapore for a travel because they earned enough, and then they went to a Singapore turtle farm, okay, and then they have an argument. The one on the left-hand side is Richard Dennis. He believed that anyone can become a good trader as long as you train them the right way. And the one on the right-hand side is Paul Bill Eckert, his good friend. He believed that you are either born with a trader's talent or you are not born. It's a nature versus nurture debate. So what they did is that they have a bet to see who is correct. So what they did is that they actually recruited. Okay, they have an advertisement on Wall Street Journal, and then they recruited about 16 turtles, 16 newbies, okay, who later on we call them the turtles, and trained them for about 2 weeks. Okay, Richard Dennis were to train them. Bill Eckert were the one who selected them. The only criteria is that they have never traded before. Train them for 2 weeks and then give them each $250,000 to trade. Okay, and some of them who did well, their amount were raised to up to $1 million. This is the result that after training them for 2 weeks. Okay, so you can see that the result is pretty good. Yeah, the result is pretty good, except the first year where there are some losses. In 1984, in 1985, they were the second batch. Okay, each batch has 8 people. The second batch was also 8 people, 2 dropped out, so only left 6. So you can see in 1986, 1987, the results were fantastic. So 1988, I think they ended the experiment with Richard Dennis winning the bet. Okay, so Richard Dennis proved to Bill Eckert that any traders can be trained in a very short period of time, like 1 week, 2 weeks. Okay, and then they can become a good trader as long as you give them the right methodology. So people were all very, very curious. Okay, what did they learn in that 2 weeks? Okay, but all the turtles or all these people, they sign a non-disclosure agreement. They cannot disclose the method they learned in that 2 weeks for about 20 years. Okay, for 20 years. So what happened was 1984 all the way until 2004. That's only when the non-disclosure agreement lapsed. That's where they can disclose legally, okay, what has been done. So of course, everyone flooded to this guy, okay, Curtis Faith. It's because everyone else still do not want to disclose anything, what they learned in that 2 weeks. Only Curtis Faith, he decided to disclose, and he actually wrote a book and published it. It's called the Way of the Turtles, okay, The Way of the Turtles. So if you're interested, you can go and find the book. All right, describing what they learned in that 2 weeks that made this miracle happen. So of course, all of them are very, very famous. So what I want to talk about is, of course, not this story, but rather what did they learn in that 2 weeks. And to summarize everything, they actually learned a way to model volatility. Okay, right. So I'm just going to share with you what did the turtles learn to model volatility in 1984, which enabled them to make this type of phenomenal return. Okay, right. So I'll give you an example. Yeah, I give you an example. The way to model volatility is the maximum of the tree. Okay, high minus low, high minus yesterday's close, and yesterday's close minus today's low. Okay, the maximum of this tree. So for example, high minus low for this day is, for example, high is 524, low is 513. So 524 minus 513 is actually 11. Okay, so that's the first number is 11. Second number is high minus yesterday's close. So high is 524. Yesterday's close is 516.5. So the difference between 524 and 516.5 is actually 7.5. Okay, so that's the second number. The third number is yesterday's close minus today's low. Okay, so yesterday's close was 516.5. Today's low is 513. So the difference between 516.5 with 513 is actually 3.5. Okay, so you have three numbers here: TR1, TR2, and TR3. TR1 is 11, TR2 is 7.5, TR3 is 3.5. And then the formula is the maximum of the three number become that day's true range. So the maximum is 11, 7.5, 3.5. What's the maximum of the three? Of course, it's 11. So 11 become the true range of the day. And you repeat the same process for the next 20 days, and you get 20 true range number. And what you get here is the average of the 20 days true range number, and the number is 11.94. Okay, so what I want to ask all of you is that what does this 11.94 represent? Okay, maybe y'all can try to type on the chat box, what does this 11.94 represent? Okay, y'all want to give it a try? I'll just give you 10 seconds to do that. If you can, you just give it a try. If you cannot, it doesn't matter. You can wait for the answer after countdown in 10 seconds. Okay. Okay, most of you give some interesting answers. Okay, right. Most of your answers are close, but none of you fully describe the answer that I want. Okay. One of the guys say totally blur. Okay, thank you for your honesty. For totally blur. Okay, it's okay to have some fun. If you don't understand it totally blur, that's fine, because why? My topics are normally quite technical. Okay, so it's okay if you don't understand. Well, it's free for you anyway. Right? So hope you just have some fun. Okay, if you're blur, but if you can learn something, that's very good. Okay, most of you got certain types of answer that are very close to what I have. One guy got the full answer. Okay, this actually measures the one guy got the right answer. Okay, it actually one guy say this guy called Onisha. Is it this? I don't know whether it's a guy or a girl, but then congratulations, you got the right answer. This 11.94 represent the volatility of the market of the month. Okay, of the month of the last 20 days of the previous month, either of the month or the previous month. Okay, it depends on whether the month has ended or not. All right, so it's actually represent. Oh, it's a girl. Onisha is a girl. Hi. Onisha, sorry. So this lady, she actually got the right answer. Okay, that is actually, so this is the first time ever the record of people modeling volatility of the market in a very systematic way, and that was during 1984. Of course, it was a closed experiment, so the public didn't know about this until 20 years later. Now everyone knows that what they learned and what this Richard Dennis taught them was actually what we call ATR, average true range. Actually, one guy got it right, but what I wanted to ask was, what did it represent? What does ATR represent? So Onisha got it right. Okay, thank you, and thanks for participating. Yeah, okay. I give you one interesting example, and this spreadsheet I can give to you for free. Okay, ask from the organizer. So what it does is that you just have to copy and paste 20 days price, open, high, low, close, and date. That's all you do. Okay, the pink color is what you need to is empty, and you need to put that number in. So it doesn't matter what you trade. Could be a share, could be a commodity, could be an index, anything, but 20 days price could be gold, right? And then you automatically come out the ATR or the number. Okay, 43.46. So this one is a S&P 500. So that's why 1 point is equal to $50. Okay, so what does it help you to do? What does this 43.4946 help you to do? What it does is that it is telling you, or is suggesting to you, what should be the right stop loss based on the market's last 20 days volatility, and also how many units of share should you trade, okay, if given a certain capital. Okay, like for example, given, let's say you have 100,000, okay, and then you are only willing to risk 2% per trade. So that means you're only willing to risk 2,000 per trade. Yeah, 2,000. But one contract you must risk 2173. Okay, not 2,000. It's a bit more than 2,000. So what does it mean? The maximum unit of trade that you are allowed to do is actually this amount times, okay, the dollar per point. So it will give you 0.92. What it tells you is that you are only allowed to trade 0.92 unit of S&P, okay, of S&P. So of course you will tell me that we can only trade one contract or two contract. There's no 0.92. Then it comes to the CFD. CFD you can trade 0.92, but that's not the point. The point is that it tells you how many units are you allowed to trade. So if it's 0.92, if you only trade futures, it tells you that you are not allowed to even trade this product because it's beyond what you are willing to risk. Okay, it's beyond what you're doing risk. You must have at least 1.00 before you can trade one contract of futures. Okay, right. So at least this ATR is a way of modeling the volatility of the past 20 days and then telling you how many units of share should you go in and what should be your stop loss price. These are the two very, very important decisions to make, because if you over trade, means you enter too many units, okay, you might lose more than what you desire. And if your stop loss is too near, you will hit your stop loss and go up, and then you will feel very, very unhappy. Or if your stop loss is too far and unnecessary, you will go down all the way and hit your stop loss, and you will lose more than what you should be. Okay, so therefore, it's very, very important that you actually have the right stop loss and the right number of contracts. These two are very important, and this ATR takes care of that using volatility modeling method, which is very, very classic, very ancient. Yeah, it's very old, but today is still effective. That it stands the test of time. Until today, it is actually still quite useful. Okay, so does it really work? Of course, I test it out myself. I program all the rules from the book, The Way of the Turtles, and I see whether, first of all, is the story real? Does it really make money? So I test it on S&P. Yes, with 1 million, it can be about 1.3 million. So it seems to me that what they claim is correct, and whatever rules are there in The Way of the Turtles, it seems that those rules can enable you to make money during their time. That only proves that the story could be authentic. That's what it can prove to me. Yeah, you can see from here that it doesn't make money every year, but certain years when it lose less. When it makes more. Okay, when there are certain years it makes about 44% return, but the most that you lose is actually 9.8% return, less than 10%. Yeah, some years you only lose 1.8%, 1.85%. So that's fine. Okay, so it seems that during that time, okay, 1983 to 1999, that period, the turtle strategy does seems to work by modeling the volatility of the futures market. Okay, by the way, the turtles only trade futures. Therefore, it's relevant to our topic today, which we are talking about futures. Okay, what? We cannot see the slide. Sorry. Am I the only one who cannot see the slide? Sorry. So, are you able to see the slide?
Yes, my side I can.
Okay. So everyone else can see the slide except the. Okay, one who cannot see the slide. All right, thank you for feedback. I'm scared if I talk, and then only you tell me I cannot see the slide at 9:30, then you know. that was what happened. I think a few days earlier. That was what. After talking half an hour there, only they asked me, have you put up the slide? Okay. Anyway, so then let's talk about recent years. Okay, how about recent years? Does it actually still works? You can see this is 1999 until 2014, the modern days, when the experiment was totally over already. Okay, all right, when the experiment was totally over already, now does it continue to work? You can see that now in 1 year you can lose up to about 59% if you were to apply the same strategy without any changes in 2000. Some years you can lose 36%, some years because there are some seminars who are out there that teach this strategy. So I just want to warn you that you can see that when you can actually make more. 148% was never heard of during that time, but you can make. At the same time, negative 59% was never heard of as well during that time, but now it's possible. So what it tells you is that in the new era, which is today, of course, now it's more than 2014. Okay, the volatility have changed a lot, and it's a lot more. Market is a lot more volatile, mainly because first of all, there is a QE. The era of QE makes the market change. Quantitative easing. Secondly, is the advance of HFT, high frequency trading, that actually makes the futures change, because HFT, a lot of high frequency trading algo bots were applied to futures market in US, different types of futures. Okay, so especially S&P and Nasdaq all those. So it definitely changed the market. So if you don't apply exactly as it is today, because you might not be able to take this type of floating loss or actual loss from year to year. Okay, all right. Because if you were to be a fund manager, and then you will actually use this to manage fund, the second year probably you'll be fired already. You won't get to see the third year, okay, or the rest. Even though overall it still makes money, but the risk has become a lot more. So that is actually the olden days volatility modeling and the issues that come with it. Okay, so first of all, if you use this method, it looks back a portion of the profit. Okay, because ATR is of the trailing stop loss nature. Okay, and second thing is it focuses on the long-term edge against other traders, which is the casino house concept. Yeah, long-term you can win like the house, but the short-term volatility may not be what you can stomach. So these are the two main problems with olden or classical or conventional volatility-based indicators like ATR. Okay, so that is the two issues that you face. You have to take note of that. That's one indicator that's very famous. Now I want to talk about the second indicator, which is also very famous. I think most of you know, which is volatility-based indicator, which is Bollinger Band. Okay, right. I want to talk about the formula. You can see the formula is very simplistic. Yeah, it's basically moving average plus 1 standard deviation upper band, 1 standard deviation minus, which is the lower band. Okay, or 2 standard deviation up to you. You can decide how many standard deviation. So the formula is actually very, very simple formula. Okay, so and it's based on the central limit theorem. Okay, in the olden days, okay, when this book was published, Bollinger on Bollinger Band. Okay, by the way, I believe a lot of Bollinger users have never read the book because I've been doing CPE classes. I know most of you who are using Bollinger Band day to day, you have actually never read this book. So please go and read the book if you are a Bollinger Band user, because this is the Bible of Bollinger Band, written by John Bollinger himself, the person who invented Bollinger. So his idea was 65.3% of the time, the market price should fluctuate within 1 standard deviation. Okay, 95.4% of the time, the market price of the asset price should fluctuate between 2 standard deviation, and 99.7% of the time, the market price or the asset price should fluctuate between 3 standard deviation. And that's only left with 0.3%, which is beyond 3 standard deviation. So what John Bollinger believed is that 3 standard deviation is enough to capture 99.7% of the volatility. Okay, that was what he believed. Okay, of course, is this true today? I'm not sure whether you agree with me, but how many of you can actually guess, okay, that during the 2008 crisis, how many standard deviation did the price crash to? You know, like, is it 3 standard deviation when the price really crashed? When you measure the standard deviation, when the price crashed every day during the 2008 crisis, how many standard deviation were ever experienced by S&P 500? And some of you might want to give it a try. We're going to type on the chat box. Is it 3 standard deviation? Or is it 4? Or is it 5? Or is it 6? Okay, right. One guy typed in, yeah, correct. I think Terry was correct, and Harif was also correct, and Ramesh was also correct. Congratulations. The answer is 7 standard deviation. It actually went all the way to 7 standard deviation. Okay, yeah, some of you are correct. We're correct on that. So yeah, so it's no longer 3 standard deviation, yeah, because the volatility has changed as compared to when this book was written. So again, all right, same as ATR. These are 2 very popular, available in every single local broker platform. Like if you're using TC Pro in your bank brokers, you will definitely get these 2 indicators. Okay, and I'm just going to show you that where these indicators are. There you go. They are here. Okay, they are here. If you have any brokerage account, CDS account, and you have a brokerage with any local broker, okay, you have almost the identical type of interface. So you can see from here that you can click the indicator section. All right, sorry, click the indicator section, and then you can actually see ATR is here, Bollinger Band is also here. All right, both of them are here, and you can definitely apply them here. Okay, right. So if you want to model volatility, if you are happy with modeling volatility, you can see that it crossed here, it actually came back here, it also went back up. This is during normal days when there is no breakout, there is no big news. The traditional Bollinger Band might still work. Okay, right. If you are happy with this, by all means use it. Okay, ATR or Bollinger Band. So, but today we are here to discuss why are we even discussing something more than this, right? If these 2 are perfect and you can make a lot of money with Bollinger Band and ATR alone, why do we even bother to discuss? So we are going to discuss what is lacking? What was lacking in these two indicators, which are developed pre-1990s? Okay, right. When we come to volatility modeling, there were three issues with financial time series data during Bollinger Band. John Bollinger's time, he did not realize this. Okay, because John Bollinger's son actually came to Malaysia before, and he's a technician as well, and yeah, we discussed and stuff like that. So they were not known at that time, but now the technical analysts, they know that these issues exist. Okay, so there were three issues with financial time series data. First issue is called unit roots. Okay, unit roots. Let's talk about the first issue first, which I just skipped. I'll go through them very fast. If you don't understand these three issues, that's fine. But I'm just going to tell you, Bollinger Band and ATR did not take into consideration how to solve these three main issues with time series data. Therefore, the indicators are not that accurate. Okay, right? That could be one of the reasons why. Might not be the only reason. Okay, but could be one of the reasons. Is my line breaking up? So my line okay?
Your line is entirely fine, no breaking.
Okay, because there are some people who type here, my line is breaking up. Okay, I hope yeah, okay, sorry. All right, fine. Okay, first issue, unit roots. Unit roots issue can cause a spurious model. I really summarize it, okay? One sentence summarize all. This sentence inside there's a lot of depth to this sentence, okay? So if you're really into this, or you're using Bollinger Band and ATR for your own trading, FCPO, okay, or FKLI, or some other things, please go back and find out what does this sentence mean, okay? It means a lot of things, okay? So I just summarize it, and then I'll just show you a non-stationary data versus a stationary data. On your left-hand side is how a non-stationary data looks like. All shares price or commodity price or futures price all look something like this, okay? The one on the right is a stationary data. All sorts of stationary data look something like this. It's more like centralized around the mean, okay? It fluctuates around the mean, okay? So you actually need a stationary data to form an indicator model, because last time all the models probably are formed using non-stationary data, could be. So because they were not aware that unit root is a problem. Okay, so first of all, let's test KLCI data. Of course, it applies to FCPO as well, FKLI data. Test for, oh sorry, that was non-stationarity. Okay, the second, okay, sorry, this one. Test for unit roots, okay, unit roots. So this comes later, okay, sorry, it's numbered. So it tests for unit roots, okay. So how to test for unit root? First of all, of course, you do not need to test it. I'm just going to prove to you that this problem exists. But if you already know it exists, there's no need for you to test again. But if you really want to test it again, you can go and get a few statistics software like maybe eView. Here I'm using eView. You can use some others like SPSS, MATLAB. All these statistics software can test for certain statistic tests like unit roots. Okay, so let's test for unit roots. So what I did here is I used an augmented decay test as a unit root test, and it's a 0 level, and it's a source info criterion as the selection. And the display, okay, what it says here is the p-value is 0.2095. Okay, it's more than 0.05. Okay, so it displays the unit root presence in the time series data. Okay, how to interpret this? You can see the null hypothesis is FKLI or FCPO has a unit roots. That's the null hypothesis. Alternative hypothesis is FKLI or FCPO data does not have a unit root. So what we are trying to achieve is we want to reject this hypothesis. We want to find evidence to reject this hypothesis and use alternative hypothesis to say that actually this data do not have a unit root, so they are perfectly fine. Okay, they can be used to create indicator. But the reality is, if you go and test any part of, I'm not picking data, yeah, you can go and test any year or any months of FKLI or FCPO. You can see that they will not pass this test. Okay, the p-value is 0.25. The critical level is 0.05. It has to be less than 0.05 to say that this data has no unit root. As long as the p-value is more than 0.05, you cannot reject null hypothesis. Means you have to say that this data has the problem of unit roots. Okay, unit root means the data is non-stationary. Okay, so I have proved to you using this test, okay, augmented decay test. If you are really into this, you can repeat the same test and probably most likely you get the same result as me, that any month or any week or any day of FCPO data, you will find they have a unique root. Okay, naturally it has. Okay, so that's one issue. Second issue is called serial correlation. They have the problem of serial correlation, highly correlated, moderate correlated, and low correlated. So I'm not going to go deep into it. It's a bit deep. Okay, but I'm just going to share with you a test. Okay, the test is called Borch-Goffrey test. We test whether does this FCPO or FKLI data, do they have autocorrelation? So is autocorrelation good or not? Autocorrelation, of course, is not good. You need to capture the autocorrelation to your advantage. Okay, you have to capture it. If your model fails to capture it, your model is not a good model, and therefore you are not able to come up with a good indicator. Okay, a good indicator must be able to capture the issue of autocorrelation. All right, so same thing. Okay, the now is that there's no autocorrelation. Alternative is there is a autocorrelation. Okay, so if the p-value is less than 0.05, that is that is an autocorrelation. If the p-value is less than more than 0.05, there is no correlation. That is the other way around for Borch-Goffrey test. Okay, so there is autocorrelation in the model, which must be captured by the model. So that is how it works. Okay, if you're really interested, YouTube this, how to test autocorrelation in eView or MATLAB. Okay, there are lots of YouTube that can guide you, so you don't have to remember. Okay, that is the second issue, which is not very important. And the third issue is of the most important. Okay, this issue is what caused you able to model the volatility correctly or inaccurately, is the issue of heteroscedasticity. Okay, in the FCPO price and FKLI price. Okay, if you want to have fun, pronounce with me again. Heteroscedasticity. Okay, come everyone pronounce. Okay, all right, just having fun with you. Okay, heteroscedasticity traits can be detected in the data. Okay, what is heteroscedasticity? It means that it is an uneven volatility clustering. Okay, what it means is that there is a period of low volatility followed by a period of high volatility and followed by a period of low volatility, and this causes volatility clustering, and this is bad. Actually, this is bad because why? Most of the indicator, including Bollinger Band and including ATR, average true range, assume that there is no volatility clustering. That was the assumption behind these two indicators. If there is, then the indicators might not be correct or might not be accurate. Okay, so there are also ways to prove heteroscedasticity test, which is here. Okay, which was here, it was earlier at the earlier slide. So to test whether FCPO FKLI data it has, you can go to eView, you can use a residue diagnostic, you can use a heteroscedasticity test method. And it is again, it's the same thing. Yeah, it is if it's more than 0.05, there is heteroscedasticity. If it's less than 0.05, there is none. Okay, you have to reject it. So these are the three problems. Okay, these are the three problems. All right, so I just say in a very, very, very general way. Of course, some of you might be totally blurred. You don't know what I'm talking about, okay? But some of you who are technicians, you will appreciate this. You will know that what is missing that makes the indicator not accurate is because these three issues are present in FCPO data, and these three issues are not addressed by Bollinger Band and by ATR. Therefore, the indicators are not accurate or not 100% accurate. Okay, let's have a look. Volatility models comparison, Bollinger Band or ARIMA. Okay, the ARIMA is a more modern days volatility-based modeling indicators that try to capture in a few of these issues. Like it try to capture unit root issue. Okay, you also try to capture serial correlation issue. It might not capture 100% heteroscedasticity issue. So it is still not 100% accurate, but at least you can see that, for example, Bollinger Band is here. ARIMA point is here to actually long. It actually is more accurate than Bollinger Band in a certain way. You can compare them. Okay, I'm not going to compare these two indicators, but I just suggest to you there are others modern days volatility modeling indicator which are more accurate than Bollinger Band, mainly because they try to address one or more of these three issues or all of the three issues. Okay, like ARIMA, like GACH, like VAR model, vector auto regression model, and VCN model. Okay, these are the models that try to capture these three issues and therefore makes their entry and exit more accurate. Okay, so ARIMA versus Bollinger Boy, it avoided some bad entries of Bollinger Band, and it has some entries that are better priced overall than Bollinger Band. I just use gold for example because a lot of people trade gold in Malaysia. Yeah, so you can see ARIMA better price than Bollinger Band is circle. These are the areas where ARIMA has a better entry price than Bollinger Band, and the rectangle is where the areas where ARIMA totally avoid these bad signals totally. So Bollinger Band entered these bad signals, ARIMA did not. Okay, that's one example of how modern days volatility modeling indicator can be superior to the conventional because they address these three issues or at least one or two of the issues. Okay, right. So same here. ARIMA signals and bad ARIMA signals, you can see it is still not perfect. Some signals are bad, okay, but some signals are okay. So for ARIMA signals evaluation, okay, so the winning rate is about 75% for radar. You can never achieve this winning rate with Bollinger Band. The most you get for Bollinger Band is about 65% accurate. 60 to 65, I would say, okay, right? It's never more than 70. You can never achieve 70% accuracy with Bollinger Band. For my own experience, of course, you might be, if you add in a few of your own things, you might increase the accuracy rate. I do not know. Okay, right. So does more modern volatility-based indicator does it do the job? Okay, you can see that these are some of the points. When it touch the point, you should be able to short here, long here, short here. Yeah, you can see that it has a certain way to it. I'll talk more about this indicator later. That's what I'll show you one or two. Okay, but it's not the main thing that I want to share about. I'm not going to sell you any indicator. Neither am I going to tell you about this, that indicator. Because today is not about indicator. Today is about volatility modeling in general. Okay, right. So first, step one towards volatility modeling is that you cannot just look at the PC Pro chart, because why the chart is static and you cannot extract the data out. So first of all, where to get the data? Okay, data preparation, FCPO data preparation. So first of all, you can get the data from TradingView, investing.com. Okay, you can get the sources of online sources for FCPO data. Of course, if you want free data, okay, you want free data, right? So that is the price of crude palm oil. There's a price FCPO, and then you can actually get the data for R, okay, FCPO data source. R is for ARIMA modeling. Yeah. Okay, you can just get the palm oil futures historical data here, and you select your dates, and then you just click download data, and then you can get your raw data. Okay, so it's very important that you have data. If you don't have data, or you don't have a way to find reliable data, there's no way you can create a new indicator, yeah, or model an indicator. Volatility modeling. So raw FCPO data of different calendar months, I collect them and then I put them nicely in a chart, in an Excel sheet. Okay, August, September, October, November, December. Okay, right. Okay, right. So these are the different months, different calendars months. I put them together. Okay, that is a free data. Paid data, Bursa station is a good example of paid data, okay, which the data I think are accurate, more higher chances of accuracy. And then you can just copy and highlight this data, and then you can paste into Excel sheet as well, open, high, low, close. So same thing, you need to arrange them nicely as well, according to different months, okay. And then of course, you can export this data from Bursa station to where? To Excel, and from Excel to where? To MT4. The MT4 is where you can create new indicators in MT4, all right. You can program new indicators in MT4 using C++ language. Okay, so MT4 is not only meant for those brokers like CFD brokers, but rather MT4 is just a platform where you can actually do testing, back testing, and you can create new indicators in MT4. Okay, all right. So that's, you can actually put all the data into MT4, and you can display an FCPO chart in MT4 using this manner. Okay, so just delete one of the symbol in MT4, and then import this piece of data from Bursa station into MT4, okay, populate it, and then all you see is that FCPO chart appears in MT4. Same for Malaysian stocks. You can actually display in MT4, okay, using these exact methods. All right, using these exact methods. Okay. Software preparation for volatility modeling, R software. Now that you get your data, yeah, now first step one, you get data. Step two is you prepare the software. Okay. Certain softwares are free, like R is free. Okay, you can go and download R. Installation of R. Okay, then you go and you can go and install package. These are the specific package to install, RCMDR and RCMDR plugin.epack. These are the two specific package to install to use ARIMA modeling, volatility modeling. Then you can copy the R script to the C user computer name, which is your own computer name, and then desktop. You can copy this. Okay, if you're really interested in the R script, I can give to you free as well, no problem. Okay, you just ask from the organizer, I can give the script. You can have that, no issue. Okay, because these are all meant for education purpose only. Certain scripts, whether they are still working, I don't know, because some of this information are slightly older when I prepare this. So the limitations, okay, now we discuss in theory, the limitations of formula of the conventional indicators, volatility detection tools is, is that there's a lot of limitation. So there is it gives rise to the new needs, okay? The conventional indicators are limited by their simplistic formula, thus the nature of the prediction is less accurate and loosely based on standard deviation in general. So there are more precise ways to estimate volatility compared to Bollinger Band, MACD, MA, stochastics. Thus better manage the risk and market volatility. So there are actually early research white papers that provide some evidence on the usefulness of quantitative models, okay, over conventional indicators in popular asset class like gold and stock indices like S&P, NASDAQ index. Okay, I give you one case study. Okay, because you might argue, my stochastic is the best, my RSI is the best, my MACD is the best. I don't want to use your indicator. That's fine. That's fine. Of course, you can use back your indicator. I'm just giving you again ideas. Okay, definitely. You can choose to research on these new ideas, or you can choose to use back. That's fine. But I just want to give you one case study. Okay, let's say about gold. Okay, you want to buy gold. You're bullish on gold. Okay, why market is a bit messy? Your market is weak, so you want to hedge. You want to use safe haven, so you buy gold. So the objective is buy gold at a good price. So what is a good price? This is where the technical indicators comes in. Yeah. So for example, a rule to use RSI might be go below 30 is already oversold, so let's buy. Okay, so probably you buy about 1220. That's where you buy the gold price using RSI. Okay. Okay. Second trader might be using Bollinger Band. Okay, so you can see that the price touched the Bollinger Band 3 standard deviation. So the price is 1221. Yeah, just now the RSI is 1220, Bollinger Band is 1221. Okay, that's fine. That's it's supposed to have a support there before it rebounds back. Okay, right. So let's talk about stochastics. Cross below 20, okay, and go up above 20, okay, is where you will actually buy using stochastics. It's 1212. So stochastic give a better price to buy as compared to Bollinger Band, as compared to RSI. Okay. Why use indicator? Okay, very simple. If you don't use indicator at this point, okay, buy, just buy. Yeah. Then it comes all the way down, you will see floating loss, and you might not be able to stomach this floating loss. Very simple. Then you might not be able to stomach this floating loss. So it is wise if you can follow exactly your indicator for entry. A lot of you might not be able to be, that patient enough to wait for your own indicators signal. So please, if you have an indicator, please follow the signal. Yeah, because you might get impatient. So even if you follow 100%, then that it depends on the signal's accuracy. Okay, so that was first of all RSI. Second is Bollinger Band. Third is stochastics. So let's have a look. Okay, let's have a look. You can see this is moving average. Go down all the way, cross, and then go up all the way. Okay, fine. All right. So you can see from here that all these methods, okay, this 1215. So all these methods compared to ARIMA. Again, ARIMA, you look at the formula, okay, and the formula includes volatility and includes the past history to actually predict the present. Okay, so it does take into consideration zero correlation to a certain way, and it definitely does take into consideration unique roots. Okay, but you can see from the formula itself, it is not very strong on heteroscedasticity if you know how to look at the formula, okay, and the error term and the constant. If you don't know how to look at the formula, that's fine, okay, but just see the usefulness. So with that piece of code that I can give to you for free, yeah, you just run it in R and you predict 1142 should be the price to buy for this gold price. Okay, just now what was the price? 1214, 1212, 1221, 122. Okay, so the price to buy should be at this point of time. Okay, the ARIMA predict that this is where you should buy the gold price. Okay, so Bollinger Band buy here, RSI buys here, stochastics buy here, ARIMA buy here, and moving average buy somewhere around here. When the whole thing is over, go all the way up, moving average will be endless. Okay, if you use moving average, I'm quite sure you will never get the bottom line. Because moving average is not about the bottom. It is a very, very, very delayed indicator. It will actually help you to filter a lot of false signal. At the same time, you will never get the best price. So ARIMA actually asks you to buy here. And when the price went up or the buy, when the wave head, it actually touches, it actually went down further. That tells you there are still room for improvement. Yeah, ARIMA is still not the best volatility-based indicator. Okay, there are still better indicators than ARIMA, but ARIMA does much better than stochastic RSI. At this point of time, all the decision has been made. Okay, all the indicators have actually show hand, show where you should buy. Okay, so it's fair. It's fair. It's not like afterwards only this show, afterwards only show. No, everyone show at the same time. It's fair. So this is R, and it plot out a graph where you should buy the upper and lower limit. Okay, that's what R is. Okay, R is that with the past 500 data, you try to project the next 20 data or the next 20 days. What is the lower price? Lower limit, what is the upper limit? So if you touch the lower limit, there is 95% chance it will rebound up. If you touch the upper limit, there's 95% chance it will rebound down, and you actually forecast a path. And whether the path is the same as the actual, we do not know. But to me, I find the upper and lower limit quite useful. Okay, quite useful. So it's something like that. Using the past data, you try to predict a path. Okay, and then it has an upper and lower limit. That's what I use. So that is similar, very similar to Bollinger Band. That's why I can compare the Bollinger Band, but it is more accurate. So I give you an example. How does ARIMA box works? Okay, so it enters, and then the upper is where you should short, and then here is where you should long. Okay, right? If that is the direction. So it touches here. You can see that it touches here. So that's where you can short here. Okay, if it touches here, that's where you can long here. Very simple. ARIMA box very simple. And then it went down all the way. Then it touches here. Then it becomes when you already enter, right? So it becomes exit point. Exit point. This is the first exit point, second exit point. So the box becomes an exit point. It can be used both for entry and exit. But remember, Bollinger Band is just like ARIMA. Both of them do not tell a direction. Okay, they are just basically volatility point for you to enter based on volatility formula. But they do not tell you should buy or you should sell. They don't. Okay, so Bollinger Band and ARIMA are quite similar in a certain way. So you can see if you just use ARIMA to short, because why the macro is short, or there's a certain reason why you want to short in the first place, then this is where you should short, this way you should short, this way you should take profit, this way you should take profit. Okay, yeah. And you can see for FCPO, let's look at FCPO. Does it work on ARIMA? This is the short point, this is the long point and take profit on a short. This is the short point, this is the long point, this is the short point. You can see works pretty well with FCPO. Okay, quite interesting. This is ARIMA on M15. It's not that accurate. I would rather you use H1. H1, every box is 1 day. It tells you upper and lower limit. If you go there, probably you will rebound. Same for yesterday, the Nasdaq as well. When it reached ARIMA point, it rebound, same as S&P. So it's still useful. This formula, I've been using it for more than 10 years. It's still useful, at least better than Bollinger Band, I know. Okay, this is FCPO, M15 chart. That's where you should short. Okay, right. So that's interesting. Okay, so that is an example of modern days volatility modeling method as compared to the older methods. Okay, let's talk about automation, because during my previous talk, there was some audience that say that I did not talk at all about automation. Okay, so I'm just going to address automation here in this. This is actually my third talk with Bursa. Okay, I've already got 2 topics. This is my third topic. So I'm going to address automation here. So those, I hope that those audience that miss out automation in the previous talk, they are here today and they can enjoy this. So how to automate? Very simple. First of all, you must be able to connect to your local broker to automate. Yeah, I give an example, but not exclusive. You can use any broker. But I'm just giving an example of RHB, for example. Yeah, I'm not favoring any broker, just to be clear. Okay. This one is actually not RHB. This is actually the UAT for TT, trading technology. This is for JF Apex. If you want to automate JF Apex, you need to pass TT. If you want to automate in RHB, you need to pass QST. Okay, quick screen trading there. Basically, you need to pass their APIs vendor, their test. So once you pass, then you can automate your FCPO trading or FKLI trading. So how to automate? Very simple. Okay, you need to be connected to them through the API vendor, and then your algo need to be connected to the API vendor. So the API vendor connect to the algo, the API vendor also connect to the broker connect to the exchange, your trade can be cleared by the exchange. So this whole connectivity is very important. The trading framework is important for FKLI and FCPO for the futures. This is for the futures, yeah. Okay, so for the stock, I'm not sure whether I have that, but today we are going to talk about futures. This is the connectivity. So, example, how do you quick screen trading? Okay, you have to install the API app, okay, in your computer. So, for example, I open up Spider, okay, and then I open a file, I use open, and I choose the demo copy. This is provided by the vendor themselves, okay, they provide you this code, okay, and then I open up the WinRHB. Okay, I wait for the app to launch. Okay, when the app appear, you select the right server and then you wait for it to launch. There are quite a few I just skip through. Yeah, and then you can see that this is your account. Your account. The most important, you must connect your account to the API. Okay, using web API JavaScript. Okay, so you connect already. What you want to see is this word called connect. Okay, initialize connection. When you see green color connected, that means your home PC is now connected to your broker's backend server and you can automate your trading of FCPO and FKLI. Okay, so you can just go and ask your broker's API vendor. You ask your broker who is your API vendor and how to connect to you for automation. Your brokers most likely will give you some guidance. Okay, so go back to your own favorite broker. Every broker have their own API connectivity method. This method is not specific to RHB. It can be used for some others, like even Affin, they use QST as well. Okay, so it really depends on your broker. Okay, then you can, of course, you can automate your orders and position here. Okay, when the algo automates trading or FCPO, FKLI, you can actually monitor the trades here. Okay, all right. So that's one part. Okay, let me talk about volatility clustering. Okay, characteristic specific to financial time series, heteroscedasticity. Okay, that is the main issue. Okay, of course, I'm not going to go into very detail because most of you are actually newbies. Okay, if I go into the details of this and if I go into the formula, you might get lost. Okay, so what I'm going to say is that there are certain things you need to do, like for example, reducing or removing, detecting the heteroscedasticity first in FCPO, and okay, answer that is, you can see that here, yeah, there is a arch test for arch process shows that there is volatility clustering in FCPO. Therefore, you need a volatility model to capture this trade. If not, your indicator will not be accurate. Okay, your arch test for FKLI data as well. Okay, it also tests that the thing is significant. It also tests that there is heteroscedasticity in FKLI data, okay, and FCPO data, both of them. So you need to capture this heteroscedasticity issue. Okay, so how? All right, how? Okay, of course, you need to know after before you capture it using the volatility model, you need to know what are the ingredients to put in the volatility model. So I have a suggestion for you, which is not really necessary, okay, but it's good to have a complete model, is to have something like an intermarket. Okay, means that your model not only capture the volatility of Nasdaq itself, but it also use some other intermarket, okay, intermarket data to actually sorry, I'm lost already. Lost myself. Okay, I'm back. Okay, use some intermarket data to predict, okay, FKLI or FCPO. So for example, FKLI related data to predict it could be HSI, Hang Seng Index, Nasdaq, S&P, or Dow Jones. Okay, and this is important. Okay, as an ingredient to your model. Your model is not only to capture the volatility clustering, but your model is what can lead FKLI. Okay, and one very important test to know how to create a good indicator for FKLI, for example, is called Granger causality test. Okay, Granger causality tells you what leads FKLI. So here it proved that HSI actually leads FKLI, but FKLI does not lead HSI. Okay, here it shows you that Dow Jones actually leads HSI, but HSI does not lead Dow Jones. Okay, and here also it shows you Dow Jones and S&P leads NQ. That's besides the point. Okay, so what it says is that Dow Jones go first, and then HSI go, then only FKLI will go. So FKLI is a lagging indicator. Same for here. Let's talk about the correlation. Okay, soya meal, soya oil, and soya bean and FCPO, they are all quite highly correlated. Okay, especially this soya oil and soya bean. Okay, soya meal is less highly correlated. Okay, and then you can see in the Granger causality that you can see that soya oil actually impact on FCPO. Okay, and actually soya bean also impact on FCPO. So you can see the Granger causality show who impact on who. Okay, so from there the co-integration is quite important. Okay, I don't want to drift too far. Okay, but I just want to show you that there are certain things, ingredient you can put into before doing just the volatility clustering. You can put this ingredient inside. This is what I did. I used vector auto regression model to actually put this ingredient inside. Okay, so with this model, what it does is that it's actually using, you can see from here, it's actually using soya bean, okay, soy oil, and a few others to predict FCPO price using vector auto correlation model. Okay, and this model also helps to remove unit root. It helps to remove zero correlation. It also helps to address the heteroscedasticity issue using this model called VAR model. Okay, and what it does is that it tries to project the fair value of FCPO, okay, based on the intermarket analysis. And this whole thing is programmed in MT4 and is made into an indicator. So when you see everything is fine and then suddenly there is a big drop, it tells you that there's a chance that FCPO might actually go down based on the movement of soybean and soy oil and soya meal and all these things. Okay, so you can see that once it drops, you can see that the price of what you want to trade might actually follow. Okay, and then all these things can be automated. All right, so I have an idea for you is that if one ingredient you can put into your volatility modeling indicator is intermarket analysis. Okay, that's what I have as my ingredient. And then from there, only you model your volatility clustering using ARCH modeling or GACH modeling. Okay, so GACH and ARCH is a more modern method compared to ARIMA. Okay, so I'm just have another about 10 minutes more. I will just show you how this method works. Okay, ARCH stands for autoregressive conditional heteroscedasticity. That's ARCH. Okay, and it actually helps to model the volatility, the heteroscedasticity, as well as the autocorrelation. It helps to model all this. All right, so I'm not going into the formula anymore. These are all the formula. I can go very detailed. It can take 1 or 2 days, but I'm just going to show you how it's being done. Okay, so ARCH equation for FKLI. Okay, you can just go to residue diagnostic ARCH test, and that is whether does it capture after you create this model, and the answer is yes. It already captured the heteroscedasticity and it no longer display that it has this issue. So this ARCH model can actually capture volatility clustering of FKLI. Okay, the ARCH equation. This is the ARCH equation. Right, that's how you do it in eView. You can use ARCH model and GACH model in eView. And it shows, okay, ARCH1 shows there's also a residue equation shows significant capture of FCPO, volatility clustering for FCPO. Significantly has been captured by ARCH as well. If it's not fully captured by ARCH, GACH will actually solve the problem because GACH is a better model by ARCH. But today I'm not sharing the basic model of ARCH. Okay, it captures the volatility clustering effect in FCPO time series. It can be proven. Okay, it can be proven that here it shows that the p-value is no longer significant. Therefore, it shows that the heteroscedasticity effect has been captured by this model. Okay, so you can use it for forecasting what is the future volatility of FCPO and FKLI. Used for forecasting as well. Okay, you can train and test the data. Okay, forecast, static forecast. All right, it will show you what could be the coming, okay, and volatility. And of course, the model you can measure its effectiveness using RMSE, MAE, MEPE, and the tail, okay, tail inequality. Okay, right, and ARCH indicator for monitoring volatility and trade, it looks something like this on the below here. Okay, that is actually the blue color is actually what is the actual volatility. The red color is the ARCH effect. You can see that it's not perfect. It doesn't perfectly predict the volatility, but it does be able to model it to a certain effectiveness. Okay, I give you one example here. How it's being used. Okay, so for example, when the price comes down, all right, you can see that the volatility clustering will show you that this is the end of the downtrend. Okay, by using the ARCH model. Okay, extreme spikes shows you ARCH model. Combined with ARIMA, this is the modified ARIMA. Yeah. Okay, if we touch here, there's a spike. It touched the ARIMA, and even better, it's also at the Bollinger Band. That tells you that triple confirm that the price could be reversing back up. Okay, and then if there's an extreme volatility, it could also means, okay, a strong move coming ahead if it's not touching the lower. If it's going up, they might also show a spike. So arch model can be used in both ways. Okay, just like Bollinger Band. Okay, so applying this into actual trading, okay, of FCPO, this is actually what happens. Okay, you can see that this one trade like this, enter here long, okay, that give about 1,100 ringgit profit in this one trade. Okay, so that's actually being applied. These models are all being applied in real life trading, and it's not just theory, it's being applied. So I have some real examples of trades that actually applying this. So arch modeling using Excel, okay, using Excel. You can do this step by step. Of course, if you do not know how to do this, you can always go to YouTube to find. There are a lot of YouTube channels that teach you how to do arch and gauge modeling in Excel. Okay, so I'm just going to go through slowly. All right, that in a fast way that you can actually use Excel step by step. Okay, using the residual square method. Okay, and by finding the realized volatility. Okay, at the same time, can we model this irregularity, which is here the volatility clustering, right? Can we measure this using the squared residue? Okay, conditional variance calculation, and of course you can see it's very complex. Yeah, if you don't know how to do this, doesn't matter, because why? You can always okay, try to find whether online there's any ready, okay, arch or gauge indicator. Okay, but the theory behind these are all the steps. If you want to do it manually step by step using Excel, that's how you can do it. Okay, you have to understand what's omega, what's alpha, okay, things like that. What's the lag square residue? All right, so with all the Excel formula one by one go in, okay, and optimizing the formula using the Excel optimization feature, okay, and that is actually the log likelihood function, all this, and then you'll be able to, what can you do with it? You can actually come up with arch model using Excel itself without using eView. You know, just now I was using eView, it's a lot easier. This is without eView, without any statistical software, just plain Excel. Okay, you can do it as well, but it is more difficult. You can see you can actually use optimization feature in Excel to find your arch model. This is your arch model, right? Okay, before and after. Okay, you can see the constant omega and alpha values are much better able to fit your volatility modeling clustering. Okay, so let's see this. Yeah, you can see this is the realized volatility. The orange color is your arch models volatility modeling. It's able to model the volatility relatively quite well, but not perfect. You can see some of the blue spikes are not fully captured, but it does capture it at the right place at the right time. So it is. You can see it is effective to a certain extent. The FCPO arch model versus realized volatility. Okay, so that is an example. In Excel, of course, I go through really fast. If you want to see step by step, please go and search online YouTube on how to do an arch model in Excel. Yeah, it probably will take you 3 days to be able to complete the whole process. Okay, right. And if you think arch is not good enough, how about try for gauge? Yeah, this is arch. And the gray color this arch is the orange color is arch model. The gray color is the gauge model. It is generalized, it's better. You can see it can capture the volatility better than the arch itself. Because why? Arch model is sometimes over parameterized. You need to have a 4 arch, arch 1, arch 2, arch 3, arch 6, arch 7. But gauge model, just gauge 1 will do. It's more parsimonious. It's a more parsimonious model, okay, as compared to the over parameterized model. If you don't know what I'm talking about, it does not matter. If you're quants, you will know what I'm talking about. Okay, so there you go. Basically, I already addressed. Okay, an example of what are the problems faced with conventional indicators like Bollinger Band and also ATR, and what are the potential volatility modeling method that can help you to overcome these limitations by addressing 3 main issues in FCPO and FKLI data, namely unit groups, serial correlation, and heteroscedasticity. Okay, so that concludes my sharing today on how to use volatility modeling method on FCPO FKLI for better trading and to create better indicator. Okay, so I think it's already 9:40. I'll pass back to the host